This is the story of how the world's biggest banks manipulated the silver market, how they were caught, prosecuted, and forced to pay the largest fines in commodity trading history. And this is the story of what's happening right now in 2026 as the consequences of that manipulation create a perfect storm that threatens to break the global financial system's grip on precious metals forever. Let's go back to where this really started. Not in 2026, not even in 2020 when JP Morgan paid its record-breaking fine, but in 2008 in the pristine trading floors of Manhattan's most powerful banks where traders discovered something extraordinary. Silver was easy to manipulate, too easy. The entire annual production of silver was worth only about $20 billion, less than what major currency pairs traded in just a few hours. It was a tiny market with enormous leverage, and that made it the perfect target. From 2008 through 2016, traders at JP Morgan Chase, Deutsche Bank, HSBC, Bank of Nova Scotia, UBS, and Barclays engaged in a practice called spoofing. Here's how it worked and why it was so devastatingly effective. A trader would enter massive orders to buy or sell silver futures contracts, creating the appearance of huge demand or supply in the market. Other traders, seeing these large orders, would react, pushing prices in the direction the spoofer wanted. Then, just before those orders could be filled, the trader would cancel them. The price had moved exactly where they wanted it, and they could profit from their real trades while everyone else was left chasing phantom orders that never existed. But spoofing was just one weapon in their arsenal. The traders coordinated across institutions, sharing customer order information, timing their attacks for maximum impact. They even had a name for their coordinated strikes against investor stop-loss orders. They called themselves the Stop Busters. One Deutsche Bank trader joked in a chat, "Ha ha, who you gonna call Stop Busters?" They thought it was funny. They were destroying the financial positions of pension funds, retail investors, and mining companies, and they thought it was a game. The extent of the coordination was breathtaking. UBS and Deutsche Bank traders agreed to short silver at exactly 11 a.m. each day, a practice they called the 11 o'clock rule. They coordinated their attacks around the London silver fix, the benchmark process that set the global price of silver. This wasn't rogue trading. This wasn't a few bad apples. According to court documents, the heads of JP Morgan's precious metals and treasury trading desks were directly involved. Hundreds of thousands of spoof orders were placed over 8 years. The CFTC would later determine that JP Morgan alone placed orders with the intent to cancel before execution in precious metals markets on a staggering scale. And here's what made it truly sinister. They didn't just manipulate prices randomly, they targeted specific moments. When the Department of Labor released employment statistics, traders would attack the market regardless of whether the news was good or bad. They struck during overnight sessions when trading volume was thin and it took minimal capital to move prices. They concentrated their attacks just before options expiration dates, dumping large volumes of paper silver to keep prices below critical strike prices, ensuring that call options expired worthless and their short positions remained profitable. For 8 years, this continued. For 8 years, every time silver began to rally, every time industrial demand pushed prices higher, every time investors saw silver as undervalued compared to gold, the manipulation would strike. Prices would mysteriously plunge during low-volume trading hours. Massive sell orders would appear out of nowhere. The market would be driven down, stop losses would trigger, and the banks would profit. But in 2014, cracks began to appear. A whistleblower came forward. Andrew Maguire, a former Goldman Sachs trader, noticed something extraordinary. He could predict when the manipulation would occur. He realized the pattern, saw how the banks moved, and he took his evidence to the Commodity Futures Trading Commission. Initially, the CFTC was skeptical. They conducted a 5-year investigation that found insufficient evidence. But McGuire was persistent, and other victims began to come forward. In 2016, Deutsche Bank made a calculated decision. Facing a massive lawsuit, they chose to settle for $38 million. But more importantly, they agreed to cooperate. They handed over more than 350,000 documents, 75 audio recordings, chat logs, internal communications. The evidence was devastating. It showed the explicit coordination between institutions, the mafia reference, the one team, one dream mentality, the casual discussion of how to manipulate prices and destroy stop-loss orders. The dominoes began to fall. In August 2020, Bank of Nova Scotia agreed to pay over $60 million and accepted a compliance monitor. In September 2020, JP Morgan Chase, the largest bank in America, admitted to wrongdoing and agreed to pay more than $920 million. It was the largest penalty ever imposed by the CFTC. The bank admitted that 15 of its traders had caused losses of more than $300 million to other market participants. But here's what made the JP Morgan case different. The Justice Department didn't just charge individual traders. They charged the precious metals desk as a criminal racketeering operation under RICO, the law typically reserved for organized crime. The Department of Justice stated explicitly that JP Morgan hosted an 8-year market manipulation conspiracy. 2 traders, Michael Nowak and Greg Smith, were prosecuted. In 2023, they were sentenced to federal prison, real prison time, not probation, not fines paid by their employer. They went to jail for manipulating the silver market. In total, 8 major banks paid $1.3 billion in fines for manipulating precious metals markets between 2008 and 2016. The evidence was overwhelming. The admissions were on the record. The criminal convictions were secured. The manipulation of the silver market wasn't a conspiracy theory. It was documented fact, admitted in federal court, prosecuted under criminal law. But here's what nobody fully understood at the time. The manipulation hadn't just created short-term price distortions. It had created a structural time bomb. For 8 years, artificially suppressed prices had discouraged new mining investment. Production had stagnated. Meanwhile, industrial demand had been growing relentlessly. Solar panels, electric vehicles, electronics, AI infrastructure, all requiring silver in amounts that couldn't be reduced or substituted. The manipulation had suppressed prices precisely when the world needed higher prices to incentivize new supply. A deficit was building. Year after year, demand exceeded production, and above-ground inventories were being drawn down to fill the gap. From 2021 through 2025, the silver market was in continuous deficit, not occasional shortfalls. Continuous. Every single year, demand exceeded mine supply. The cumulative deficit over those 5 years reached approximately 820 million ounces. That's nearly an entire year of global mining production just vanished from above ground stocks. And remember, silver isn't like gold. Gold is rarely consumed. It's hoarded, stored, recycled efficiently. But silver, more than half of annual silver demand is industrial. It gets used in products, spread into thin films on solar panels, incorporated into circuit boards. Much of it is effectively destroyed, never to be recovered economically. The metal was disappearing from the system. Then came 2024 and 2025, and everything changed. Silver entered 2024 trading near $24 per ounce. By the end of the year, it had climbed to roughly $30. A solid year, but nothing spectacular. But in 2025, something broke. The price didn't just rise, it exploded from $28.92 at the start of the year to over $70 by year's end, a 147% surge in a single year. Silver hit new all-time highs, surpassing the peaks from 1980 and 2011. the previous records. The levels that had stood for decades were shattered. What happened? The same forces that the manipulation had suppressed for 8 years were now unleashing with compound interest. Industrial demand surged by 7% in 2024 to over 700 million ounces, a new record. The renewable energy sector, particularly solar panels, was consuming silver at an accelerating rate. Projections showed that solar alone could consume 100% of silver supply by 2050. Electric vehicle production was ramping up. AI infrastructure with its massive server farms and data centers required sophisticated electronics loaded with silver. This demand was inelastic. These industries couldn't simply switch to alternatives if silver got expensive. They needed the metal, period. On the supply side, nothing was coming to the rescue. Global silver supply had actually declined from 1.07 billion ounces in 2010 to roughly 1.03 billion ounces in 2024. Mining production had increased by only 2% in 2023, barely keeping pace with grade decline at existing mines. Mexico's regulatory changes in 2024 and 2025 cut expected output by 5% in affected regions. Russia's mining sector faced ongoing sanctions and capital constraints. Several major primary silver mines were approaching end of life with no large replacement projects in development. The lead time to bring a new major silver mine into production is typically 7 to 10 years. Even if mining companies started aggressive exploration programs immediately, new supply wouldn't arrive until the early 2030s. Meanwhile, inventories at the major exchanges were being drained. COMEX and London Bullion Market Association warehouses both drew down through 2024 and 2025. The availability of good delivery bars, the standard form for institutional trading, tightened significantly, and this is where the real crisis began to emerge, the crisis that's gripping markets right now in early 2026. You see, the silver market operates on two parallel systems. There's the physical market, where actual metal changes hands, and there's the paper market, where futures, contracts, options, and derivatives trade in volumes many times larger than the physical metal that actually exists. For decades, the paper market dominated price discovery. The futures exchanges in New York and London set the global benchmark price for silver. Physical buyers and sellers would reference these paper prices for their transactions. The system worked as long as everyone had confidence that paper contracts could be converted to physical metal when needed. But confidence is a fragile thing, and in 2026, that confidence is shattering. Here's what's happening right now at this very moment. Silver is trading around $73 per ounce in the Western paper markets. But if you want to buy physical silver in China, you're not paying $73. You're paying premiums of up to 120% over the spot price. That means Chinese buyers are valuing physical silver at around $160 per ounce. Read that again, $160. In Japan, premiums on secondary markets have surged to around 60%. In Dubai, premiums are running at 40%. The physical market is screaming that silver is worth far more than the paper price suggests. Why? Because there isn't enough physical metal to meet demand. In early January 2026, silver lease rates, the cost to borrow physical silver for short periods, exploded to around 8%. Under normal conditions, these rates sit at about 0.3 to 0.5%. An 8% lease rate means market participants are willing to pay 8% annualized just to borrow silver to ensure they can deliver on their obligations. That's not a healthy market. That's a market in crisis. That's a market where having physical silver has become more valuable than having a paper claim to silver. What we're witnessing is a physical run on the paper silver system. Institutional buyers who previously were happy to hold futures contracts or exchange-traded fund shares are now demanding physical delivery. They want the actual metal in their vaults, not a promise of metal, and the system is struggling to provide it. In December 2025, COMEX inventories experienced a 60% drawdown in just 4 days, according to market data. 4 days. more than half the available metal gone. Chinese banks suspended silver trading accounts for retail customers and imposed dramatic margin requirement increases in October and November 2025 as they scrambled to manage their exposure. And here's where it gets truly interesting. The same banks that manipulated the market from 2008 to 2016, they're now on the other side of the trade, and they're hemorrhaging money. In October 2025, TD Securities reported a verified loss of $2.39 million, closing out a failed short position. That's just one instance, one desk, one bank. How many other losses are being hidden in quarterly reports? How many short positions taken years ago when silver was trading in the 20s and 30s are now underwater, with silver in the 70s and physical premiums suggesting the real price is over $100. Remember JP Morgan's $920 million fine? That's starting to look like a bargain, because what's happening now isn't a fine paid to regulators. It's the market itself extracting payment. Every short contract that has to be covered, every physical delivery obligation that has to be met by buying metal at enormous premiums, every hedge that's failing because the paper price and the physical price have diverged so dramatically that traditional arbitrage relationships have broken down. This is what happens when manipulation ends and structural deficits collide with suppressed investment and surging demand. The mathematics are unforgiving. In 2026, the market deficit is expected to reach approximately 200 million ounces. That's roughly 20% of annual mine production. It has to come from somewhere. Above ground stocks are already depleted from the previous 5 years of deficits. Recycling can't scale fast enough. The only adjustment mechanism left is price. But here's the twist that nobody saw coming. It's not just about supply and demand anymore. It's about the loss of credibility in the paper markets. For decades, the Western financial system maintained price control over precious metals through the futures markets. The ability to trade massive paper volumes with relatively little capital meant that paper markets could overwhelm physical markets in price discovery. But that system depended on confidence. It depended on the belief that paper contracts were as good as physical metal. That belief is evaporating. China's government reportedly imposed export controls on silver in January 2026, though the exact scope remains unclear. If true, this removes additional supply from global markets at precisely the wrong time. Central banks, which have been aggressive buyers of gold since 2022, are reportedly beginning to add silver to their reserves. The World Gold Council reported that central banks purchased 1,037 tons of gold in 2023, the second highest annual total since 1950. If even a fraction of that interest shifts towards silver, given silver's much smaller market size, the impact on prices would be enormous. The renewable energy sector isn't slowing down, it's accelerating. Government mandates for transition away from fossil fuels are multiplying. Every major economy has net zero targets. Solar capacity is being added at unprecedented rates. Each gigawatt of solar capacity requires approximately 36 tons of silver. Global solar capacity additions are measured in hundreds of gigawatts annually. Do the math, that's thousands of tons of silver consumed each year, and the rate is increasing, not decreasing. This silver isn't coming back. It's locked into panels with 20 to 30-year lifespans, and recycling economics are poor. The electric vehicle revolution is following a similar trajectory. A conventional internal combustion engine vehicle contains approximately 15 to 30 grams of silver. An electric vehicle contains roughly 30 to 60 grams. With EV sales growing exponentially, particularly in China and Europe, this incremental demand adds up quickly. And we haven't even discussed the AI boom. Every data center, every server farm, every AI chip requires sophisticated electronics with silver. As artificial intelligence becomes embedded in every aspect of the economy, as companies invest hundreds of billions into AI infrastructure, That's yet another source of structural demand that wasn't fully anticipated when mine development decisions were made a decade ago. The gold to silver ratio, which measures how many ounces of silver equal the price of 1 ounce of gold, has historically averaged around 67 to 1. For years, it's been well above that level, sometimes exceeding 90 to 1. Even with silver's rally to $70, the ratio remains elevated. If the ratio were to revert to its historical mean and gold continues its own bull market, the mathematical implications for silver prices are stunning. With gold trading above $3,000, a 67 to 1 ratio would put silver at roughly $45. But that's using the depressed historical average. Some analysts argue the ratio should be even lower given silver's increased industrial importance relative to gold. A 50 to 1 ratio would put silver at $60. A 40 to 1 ratio, $75. And that's assuming gold stays flat, which it isn't. Some of the most bullish forecasts for 2026 come from analysts who've studied these dynamics closely. Alan Hibbard from Gold Silver predicted silver could increase by over $100 per ounce to $175 or higher. That's not from the current $70 level. That's additional gains. Bank of America suggested silver could top out between $135 and $309 in certain scenarios. Robert Kiyosaki believes $75 can be reached, which already happened in January 2026. Philip Newman from Metals Focus projects a potential target of $70, which was reached and exceeded. These aren't fringe commentators. These are institutional analysts revising models that were never built to handle the kind of structural deficit and physical squeeze that's unfolding. Yet even with these explosive moves, even with silver up 132% year over year as of early February 2026, the market remains profoundly unstable. On Friday, February 1st, silver plunged as much as 9.6% intraday to around $64 before recovering above $70. The volatility is extreme, the highest since 1980. Why? Because speculative positioning is enormous. Chinese traders in particular piled into silver during the January 2025 rally, adding speculative froth. When sentiment turned on concerns about Federal Reserve policy and a strengthening dollar following the nomination of Kevin Warsh as Fed chair, that speculative money rushed for the exits. Silver dropped roughly 40% from its late January peak of around $90 before recovering. This volatility reveals the fundamental tension at the heart of the silver market in 2026. On one hand, you have structural deficits, physical shortages, surging industrial demand, and elevated premiums in Asia that suggest the fair value of physical silver is well above current paper prices. On the other hand, you have speculative positioning, paper market dynamics, central bank policy shifts, and dollar strength that can create sudden, violent corrections. The battle between these forces is creating price swings that would have been unthinkable just a few years ago. But here's what the volatility obscures. The structural issues aren't going away. A 10% price correction doesn't create new silver mines. It doesn't change solar panel requirements. It doesn't reduce EV production. It doesn't make Chinese buyers suddenly willing to accept Western paper prices when they know physical metal isn't available. Every sharp correction gets bought because industrial users know they need silver and supply isn't getting better. The paper market's grip on price discovery is weakening. Shanghai, Hong Kong, and other Asian exchanges where physical delivery is more common and premiums reflect actual supply-demand conditions are gradually building an alternative pricing system. This is the nightmare scenario for Western financial institutions. Price leadership shifting away from New York and London's leveraged dollar-denominated paper markets toward exchanges that care more about physical reality. Silver exchange-traded products saw record inflows of 95 million ounces in the first half of 2025, according to market data. But here's the uncomfortable question that nobody wants to answer. How much of that metal actually exists? Most silver ETFs operate through complex structures involving authorized participants, custodians, sub-custodians, and unallocated metal. They rely on fractional reserve-style banking principles where not every share is backed by segregated physical metal. Under normal conditions, this works fine. Under physical stress, it doesn't. If a significant percentage of ETF shareholders demand redemption and physical delivery simultaneously, the system could face a crisis not unlike a bank run. The same applies to the broader derivatives market. JP Morgan reportedly holds approximately 713 million ounces of silver across COMEX positions and SLV ETF custody as of late December 2025. That's an enormous position. But is it all physical? How much is leveraged through derivatives? What happens if physical premiums continue to diverge from paper prices? The bank with the most infamous history of silver market manipulation now holds the largest position at exactly the moment when the market structure is potentially breaking down. Basel III regulations, which became effective in 2021, impose an 85% funding charge on banks' unallocated precious metals positions. This creates a strong incentive for banks to minimize paper exposure and favor physical holdings. It's one reason why banks have been less willing to maintain large synthetic short positions in recent years. But it also means the traditional shock absorbers in the paper market, the willingness of banks to provide liquidity by taking the other side of trades, has been reduced precisely when the market needs liquidity most. Some analysts suggest that what we're seeing in early 2026 is just the beginning. They point to the fact that mining supply will continue to decline or stagnate. They note that it could take half a decade or longer before new projects come online, assuming exploration and development starts immediately. They highlight that industrial demand has nowhere to go but up as electrification, renewable energy, and AI continue their exponential growth curves. And they emphasize that once a physical squeeze begins in a commodity market, it tends to be self-reinforcing. Higher prices don't immediately bring new supply. Instead, they create panic buying from industrial users who fear being unable to secure metal, which drives prices even higher, which creates more panic in a feedback loop that only breaks when demand is literally destroyed by price rationing. Is silver going to $100, $150, $200? Nobody knows. Anyone who claims certainty is lying. Markets don't move in straight lines, and the speculative volatility we've seen in early February 2026 proves that sharp corrections can and will happen. But what seems increasingly clear is that the silver market has entered a new regime. The 8-year manipulation from 2008 to 2016 suppressed prices, discouraged investment, and created an artificial stability that masked building structural imbalances. The prosecutions from 2016 to 2025 removed the manipulation but couldn't immediately fix the supply deficit. And now in 2026, the consequences are playing out in real time. The banks that once controlled the silver market through spoofing, coordination, and massive paper positions are finding that physical reality ultimately wins. You can manipulate paper markets. You can place orders you don't intend to fill. You can coordinate with other banks to attack stop losses. You can suppress prices for years, but you can't manipulate the fact that solar panels need silver. You can't manipulate the fact that mines take a decade to develop. You can't manipulate the fact that 820 million ounces of above-ground inventory has been consumed from 2021 to 2025, and you can't manipulate Chinese buyers who are willing to pay $160 for physical metal when your paper contracts say it's worth $70. The silver supply shock of 2026 isn't about a temporary squeeze. It's about the collision of decades of underinvestment, years of manipulation-induced supply destruction, surging structural demand from industries that define the future economy, and the potential breakdown of the paper market system that has controlled precious metals pricing for generations. It's about what happens when financial engineering meets physical reality and physical reality starts to win. 2 traders went to prison for manipulating the silver market. 8 banks paid $1.3 billion in fines. But the real punishment is being delivered right now by the market itself as short positions collapse, physical premiums explode, and the entire structure of silver price discovery faces its most severe test in modern history. The manipulation ended years ago, but its consequences and the supply crisis it helped create are just beginning to unfold. This is the silver supply shock of 2026. And we're watching it happen in real time.